Good morning, ladies and gentlemen. Future here of FutureMeDead.com. It's been a good week in the land of FMD, and I want to do a quick recap with regards to the last couple posts for members only. So let's get right into it, and let's go back to the technical analysis post on Valiant. That's ticker symbol VRX. This was posted on the 5th of May. And I get a lot of questions with regards to Valiant because one, it is covered quite often in the media, so it does get a lot of exposure with individual investors, which means I end up getting a lot of questions with regards as to when we should be buying this. The analysis was straight up bearish. You can see here many times. What I try to do is to convey my bias very clearly. I'll state the name of the company and my bias. Sometimes it's bearish, neutral, or bullish, and sometimes I'll explain. I'll add a brief explanation such as counter trend bounce to or what have you. But let's go right into the chart that was posted. So this is the daily time frame of Valiant. This was posted on the 5th of May, and the Elliott wave count isn't too clear. However, we try not to be one-trick ponies in the land of FMD. If Elliott wave is not telling me anything, then we can resort to other tools in our arsenal. In this case, we were simply looking at the 50-day exponential moving average and the 50-day simple moving average here in red and yellow. Now, the reason I like to see both of these is because whenever the price tends to spike above the 50-day moving average, simple moving average, the 50-day EMA will be there to catch the peaks. You can see here it did so on multiple occasions. And one of the things that we do here as swing traders and investors is we like to respect the trends that are already in place. So the fact that the 50-day moving averages were providing resistance here previously, and since price has not gone above these moving averages, we can extrapolate this behavior and say that the 50-day moving averages are going to continue to provide resistance. And so this was noted here on the chart as an approaching 50-day moving average, which can also be interpreted as approaching resistance. Okay. However, this was above current price action, and it was above another pattern, which is a candlestick formation called a triple top formation. You can also see this under bar charts. Basically, there were 3 attempts to pierce the area surrounding 37, once, twice, 3 times here, and has failed. Usually this is similar to baseball. It's 3 times and you're out. So investors do lose patience whenever a rally fails to overcome resistance, and then the trend resumes lower. So what we were looking at here was this triple top formation with potential compounding of this resistance with the approaching 50-day moving averages. You can see here, basically, this was clearly written as, it was described as stiff resistance. We think this compounding of resistance in the area between 37.20 and 41, 41 is where the moving averages were at the time, is stiff resistance and should hold in the short to medium term. This short description of the 2 charts was finalized with this. Trigger for the short would be a break of the dotted lower line, which currently comes in at 29.60 and rising. That is this lower dotted line here. Okay, you could have gone short here at 34.47, but just to be safe, you want support to break because that is your signal that the trend has resumed. Okay, if you're a little bit of a gambler, if you like to take higher risk, then you would short higher, hoping that price does not surpass this triple top or perhaps the 50-day moving average. But we're conservative here on FMD. We like to minimize risk. We always analyze risk first. And we also like the market to tell us the direction of the trend and to tip its hand. We try not to guess or play the 50-50 game. We want odds in our favor at all times. So let's take a look at the the live chart here of VRX, and you can see here that price has succumbed to the lower dotted support line. So if you would have gone short at the break of this line, let's use this candle at the close. As of right now, you would be gaining 17.65% of your position. Okay, so this is one of the winners for the week. I know some of you took advantage of this. Some of you that are actively looking to short stocks. I know we've been talking about the market being top, that there's an opportunity for the bears, and this was certainly one of them. Even recently today, I just tweeted that we should not be in high beta stocks. We should not be in risk. We need to be in the bluest of blue chips if you absolutely have to have exposure to the market. Valiant is certainly not one of them. So this was a short candidate that is working out for us. The target was for a new low with extensions all the way down to 21 and 20. There is actually slighter support with in the area surrounding 23. Let's just go over to the weekly chart so we can see. We'll use these two candlesticks. Let's zoom in a little bit. And basically we're going back all the way to 2010 to look for minor support in the area surrounding, let's just call it 24. We're currently trading 24.60. This is dropping with conviction. I'm not even going to say this is certainly not an area to buy. This might be an area to perhaps liquidate a portion of your position and book partial profits. But we do have lower support moving forward. Either way, this is one where you want to manage your stop correctly. Every time this takes out support, lower your stop. Remember, identify your risk. That's step one. Step two is to bring your stop over to break even and then look forward to your target. So that's it with regards to Valiant. Let's move forward and take a look at the broad market. A few days ago, actually on the 6th of May, so this was the day after the VRX post, I posted this. This is what I'm looking at in the S&P 500 E-mini futures contract. We were looking for support in the area of the 50-day moving average. This is the ES. Front month. This is actually a continuation. And we were looking for a retest of the upper dotted trend line before we move lower. So we actually initiated a long trade based off of this because the internal substructure of this was a clear pattern, and we like to trade clear patterns. More often than not, I don't care what trader you follow, more often than not, we don't know what the market is doing. I can't tell you what the market is doing every second, every minute, every hour of the day. What I look for is for patterns that are clearly defined in the Edwards and McGee book, in the Elliott Wave Principle, in the Candlestick Bible. I look for patterns that are clearly defined, that we know, that we're comfortable trading. Whenever the market shows me that, then I move in with real money. But sometimes doesn't matter how often I study the market or all of these books, there are periods of 100% uncertainty. There are times where I have to sit back, look at the chart and say, I don't know what's going on. And I will simply just sit on my hands until the market tips its hand. So this was one of those moments where we had declined into the 50-day moving average. And if you look at the short-term pattern, this is in the 1 hour time frame, this was a clear A, B, and C wave formation that only completed, under my analysis, wave A of a larger ABC. So we went long here with members looking for a retest of this upper trend line. So we didn't do that with the S&P 500. We actually did that with the Dow because the Dow was slightly and currently is slightly outperforming the rest of the markets. You can see here, this is a quick list of ETFs that I track, and you can see here, even today, the S&P, excuse me, the Dow, this is the ETF for the Dow Jones, is declining less than the IWM and QQQ, which are measures of risk. The Dow Jones and the SPY are tend to be safer than the other two. So regardless, we went long via UDOW, which is a 3 times leveraged ETF. So this is the live chart. You won't see any labels on here, but basically it did mirror this pattern here because they do move more or less in tandem, as all of you should be aware. Okay, so this was the ending diagonal wave C, which is a high confidence a pattern. You can see here this little blue arrow. This is where we went long, and this little red arrow is where we got out of the trade. So this was a successful trade. So why did we get out specifically at 69? We went long here, I believe in the area of 66 and got out at 69. The reason is because I didn't explain this to members either, so I'll do that now. Not only did we have this dotted trend line, which we knew was going to provide resistance, excuse me, but we were expecting this to be a B wave, okay, which means this was the rally was only going to be a partial retracement of this initial decline before we move lower in wave C. So we wanted to be in and out of the trade. This lasted a pair of days. So let's do the typical Fibonacci retracement of circle wave A. Common retracement for B waves are the 50% and the 61.8% retracements of the preceding pattern. You can see here this was also an A, B, C. Actually, I believe I have my labels in. Here we go. Okay, so the difference between the DIA, this is simply the ETF that tracks the Dow Jones, and the UDOW is the 3 times leveraged version of that. So let's stick to this chart because I have my labels here. You can see here we had a 3-wave structure to the upside. And interestingly, it rallied exactly to the 61.8% retracement of circle wave A before reversing lower. So getting out at 69 in the UDOW was a very timely trade based off of this. This is a common stopping point. It's a common reversal point. So we didn't want to hold and hope for higher prices. We basically took the meat and potatoes of this ABC pattern and we got out. We're happy to be profitable, and we're very lucky to have gotten out in time because wave C appears to be underway. You can see here this decline is very much impulsive. C waves are always 5 waves. They are always impulsive. So this looks like a 1, 2, 3, 4, and 5. Very likely a wave 1 of a larger 5th wave to continue lower for the next few days, maybe even weeks. We'll see. So this was the trade in the UDOW and in which tracks the Dow Jones. So that was the trade analysis for the ES, the SPY, and how we extrapolated that in the Dow. You can see here, target hit 69, flat for now. So I'm going to conclude this video by actually giving you a a forecast moving forward. After that, I need to get to writing the weekly 5 for this week. Members are kind of hitting me up for that. Everyone wants to know where crude is going. And so that'll be for members only. Let's take a look at we go back to this chart here. You can see I have fixated a wave 1 towards this rally, which means I'm expecting, not expecting, we are currently working, the current forecast is one that we are working in a second wave that is going to retrace a portion of this large rally that we had from the end of March all the way to April. So the current decline, that is this ABC, is too shallow to be all of wave 2. Can it be all of wave 2? Yes, it can, but it is not probable. Okay, more often than not, second waves tend to be deep retracements, which leads me more often than not to retrace 50 to 61.8% retracement. Bit of a dire of a forecast. Let's go over to the, let's do this. Brand new chart for the ES. Let's go to the daily. Let's clear all of this. Okay, so if this is wave 1, and I'm expecting a second wave, for starters, let's do the typical fib zone, which is the 38.2% fib through the 61. Okay, so based off of this alone, I could tell you that if wave 2 were to be shallow, it should still drop below 2000 on the ES. Now let's add your typical moving averages. Let's look at where the 200 is. Okay, investors love the 200-day moving average, so let's point that out. Currently comes in at 2006 and is pretty much flat, slightly declining because of the severity of this decline. So the forecast moving forward is one where we're going to go much lower. We can also do a Fibonacci projection between waves A and B. Many times waves A and C are equal in length. So let's take the distance of wave A, project that lower from the termination point of wave B. This gives us a target of 2005, which is exactly where the 200-day is currently at. So this is, in the short term, this is the target. Are we going to get there tomorrow? Probably not. But this is what we're looking forward in the next few weeks. How we get there, we'll see. This is the purpose of the weekly 5. We try to look at the internal structure of the decline to help us have the best operative wave count. So that's it for now, guys. Always check me out at FutureMeDead.com. I'm on Twitter, often blasting hints and tips. The handle is at FutureMeDead. And just so you guys know, the cost of the service is $20 a month. More often than not, I'm identifying risk for clients privately. I get a lot of questions via email. And this is what I do. I try to steer you away from risk, whereas others are more often than not just giving out Twitter calls and identifying targets without identifying risk first. So that's it. I hope you guys have a wonderful day. I'm going to be traveling to Denver tonight, and I'll be there for the rest of the weekend. I'm going to be checking out beautiful uh, downtown Denver and Boulder, Colorado. So if you guys are up there, hit me up. Perhaps we can meet up. Best of luck.